Good evening, Kipp. Can you hear me?
Yeah, good morning to you guys. And yeah, good evening from here, I guess, just outside New York after that walk-up song.
Thanks very much for joining us, Kipp, and for waiting up a little bit in the evening. As Tom said in the introduction, Aries, very large today, but it hasn't always been that large, and you joined well over 2 decades ago. Maybe you could give people in the room just a bit of backstory on how the business has grown and your involvement in particular, and also what have been some of those key moments along the journey that have helped that growth.
Thanks for giving me an opportunity to, I guess, pipe myself into the conference. I hope it's a great day or so for you all. So let me give just a quick sort of summary as to where Aries is today. For those of you who maybe are less familiar with the firm, we're a large and growing global alternative asset management firm, really focused on the primary markets and the secondary markets in credit, private equity, real estate, and infrastructure. And as you mentioned, the firm was started in 1997. It was actually started by a handful of the original Apollo founders that had been in Los Angeles most of their careers, coming through the Drexel Burnham and then Apollo network, and spun off in 97 really as a desire to focus on credit. Is really where we started. It's come a long way. We're now a public company with a almost $60 billion market cap and about 4,000 people globally. And the real busy places at Aries today are still Los Angeles. We've got about 700 people there. New York, which was the office I opened with a handful of partners in 2004. We're about 800 people in New York now. And we've got a pretty large office now in London as well. We're probably 400 or so strong in London, but all in all, it's about 50 offices. But obviously the excitement about attending today too was the fact that the APAC region for us is a real focus for growth, and that includes Australia. So and that's both in investing and in distribution. So to give you a few numbers specific to where you all are, in APAC today, we've got about 37 billion of AUM and 330 investment professionals in 15 distinct offices. And I think even more importantly to what you're all doing there today, we've got a pretty significant team on the ground in Australia investing across 5 asset classes locally. So over there, we're in the direct lending business, we're in the alternative credit business, we're in the opportunistic credit business for us, sort of distressed and capital solutions. We're in the infrastructure business, and we also participate in the private equity markets there. So I'm really delighted to be here with you all and just give you some thoughts on where we are in terms of my own journey. I mean, it's been a very rewarding one. We started in New York. The firm had about 60 people, and it's been really fun to, frankly, work with a handful of folks across the firm that continue to run it today. We've all really kind of grown up together, and it's a culture of transparency and partnership and collaboration. And most of the folks that I'm working with in New York either started with me opening the office, or folks that we've hired going back to 2004 that are still with the company. And that really we think makes us unique in a lot of ways in terms of culture and our approach to things. Yeah. But for me, I come up through the credit business. I ran that up until February, when one of my partners in London, Blair Jacobson, and I were promoted to co-president. So we've taken on some sort of additional responsibilities across the firm that are more broad-based. But my background is having built the direct lending businesses and the private credit businesses, and then taken on all of credit probably 8 or 9 years ago.
Yep. We'll definitely talk about some of the growth ambitions in just a moment. But your time involved in that lending and credit business, a couple of decades, the growth has been over a few decades, including the GFC. Private credit and direct lending in Australia is behind where you are in the US in terms of how long it's been around. It's a asset class that's still developing, and even to the extent that the local regulator is seeking to partner with industry to understand what does good look like, what is best practice. I was wondering if you could talk about what that journey was like And what did you learn through those times around what does good look like and what does best practice look like in credit and direct lending?
Yeah, for sure. I mean, look, it depends on how you want to come at it, because we do think of private credit as sort of a spectrum of distinct sub-asset classes. So you have, more traditional direct lending. A lot of that was built, lending to sponsors and to private equity-backed transactions. And increasingly, we've extended our definition of private credit to include other things. And I'll come back to why that is, but things like asset-based finance, opportunistic credit, certainly real estate debt and infrastructure, and they're all a bit unique and have just different risk return profiles. But I think what we found, our experience, most of us in this was we start careers in banks, right? Either in leveraged finance or in high yield or as principal investors. And what we found over time, even before the financial crisis, was the US banks had consolidated to a point at the upper end where the middle market, where we like to attack in terms of credit, was really just not all that strategic anymore. So even before the regulatory changes that came with the GFC, it was pretty clear to us, leaving banks to go set up in an asset management firm, that this business was going to be much better run, at least in the States, and certainly as we figured out later in Europe. And I think we're figuring out in APAC as well, much better to run these assets in a bank, right? And or outside of a bank, sorry. And you think about how you finance your assets, going to longer term investors, getting longer term liabilities. But the key to it really, and I'll say to your question about Australia, I think being an early mover is a great advantage, right? And we've stuck to the same playbook, frankly, in the US, Europe, and now in APAC, which really is built around building very large origination teams. Some of the folks internally, we'll refer to it as boots on the ground, but we have 50 offices around the globe because we think that local presence makes us really unique sourcing deal flow. And then once we're obviously bringing in the widest funnel of opportunities, it's a very similar business, and one, I think you guys are following over there too. It's long time to close a deal, private equity style due diligence, right? And the volume of new opportunities coming in allows you to be incredibly selective. So it's all about sifting for what you feel is the best risk reward as you're performing your underwriting process. But I think equally important is just the fact that we've put real resources into thinking about portfolio management and risk culture in terms of what you have longer term, because these are illiquid assets. You should expect to be invested in those assets for a long period of time. So you not only need to be able to originate and underwrite them, but you need to be able to manage them well, because you're not always going to get everything right? Not every situation is going to work out as expected, and they certainly don't for us, regardless of geography. And when that happens, you need to have both the willingness and the resources to go in and actually, take over businesses if needed, and bring new management teams in. So there's a fair bit of principal investing styles that live across our asset classes that are really relevant to credit. But it's an emphasis on downside protection. It's an emphasis on underwriting really good companies that we think have second way outs if things don't go as expected. And look, I think the Australian market is showing a really significant opportunity, which is why we've stood a team up there and have continued growing. Right, the traditional banks are becoming fewer and larger. Small, mid-sized borrowers are finding it harder to procure loans and all of that. So we think there's a huge opportunity over there for you all and, well, frankly, for us all. So we're excited about it, but we're coming at it with the same intention and the same playbook that we've had building the US and European businesses, I think both which are, market leading businesses in their respective geographies.
Yep. And Kipp, let's talk about the growth ambitions. You're based over there in the US. You have a counterpart over in Europe. You've talked about APAC. From a geographical perspective, where do you see the big opportunities? And maybe below that, talk about some of the, the asset classes and some of the subsectors underneath it that you're where you're seeing growth opportunities.
Yeah, look, we have 5 businesses in credit, and they're all large and growing, and we're happy with them. I don't think we need to do anything monumental there for that growth to continue, because all of those businesses participate in very large addressable markets where we have, well less than 5% market share. So with a leading position, we can grow credit, I think, without doing much other than continuing to kind of press our advantages. So our focus over the last 5 or so years, both through acquisitions, but also through team building and kind of organic growth, has been, frankly, on the real asset side, and then with increased growth across Europe and now Asia. So we've done a couple of acquisitions in Asia, a credit manager, a private equity manager, and most recently a real assets manager, largely focused on Japanese logistics investing. And with that also comes a pretty significant data center development and management capability. So on the primary side, it's been diversifying away from credit and really looking at real assets and infrastructure as being areas that we're excited about in those two geographies in particular. The only other thing I'd call out is, I think because of the way that the markets have gone the last couple of years, and there's been a lot of chatter about this lack of capital coming back to LPs, we're seeing a bit of a shining moment in our secondaries business, which is growing very rapidly, right? Because that's a way for some of the existing capital in the system that's not getting returned as quickly to LPs to actually, unlock a bit. We've seen, 30% growth in AUM in our secondaries business in the last 12 months. That's pretty remarkable. And just to emphasize it, we actually have secondaries businesses that kind of set up alongside each of our primaries, right? So again, credit, real estate, PE, and infrastructure. We think the firm really benefits. We think our investors benefit by being in the primary markets and the secondary markets in all 4 of those asset classes in all 3 of these geographies. So that's kind of the focus in terms of investing. I'd say in terms of distribution, Ares has grown up historically as an institutional firm, right? So we would raise largely commingled funds from pensions, insurance companies, sovereigns, et cetera. And what we've done, I think, well in the last 6 or 7 years is diversify our distribution into the wealth channel and also through the insurance business that we've been building as well. In terms of the Australia expansion, look, we first launched our private wealth products over there in 2020. Our on-the-ground direct lending strategy was 22. So, these are just natural extensions, both on the investing side and on the distribution side, that we've come to your market with, but that I think we see in other areas that we haven't penetrated yet.
Yeah. And Kipp, just in terms of, the geography, the world economy, different regions, Europe, where you've got your counterpart there, does the economic backdrop across the globes dictate where you see opportunity, and does it have an influence on where you're likely to be most active?
Yeah, I mean, yes and no. I mean, it's a tricky question. I would say that when we go out and we actually build something, we're not building something as a trade. We're building something as what we see as an attractive long-term business where we can build a quality team and sustainable advantages. So our views of different economies may make us a little bit more skittish or a little more excited in certain geographies from time to time. But despite that, it's a pretty consistent role in each of these geographies, and all the businesses today are busy. There may be a couple of exceptions, and the world seems to be a difficult place to predict right now in terms of where we're going. But no, each of the businesses remains in focus, and I'd say in growth mode, things that we're committed to longer term. And again, when you're making investments that you expect to hold 3, 5, 7 years, you have to take a longer term view.
Yep. And in terms of demand for capital, are there any areas where you see imbalances that, from an industry or a sector-specific, opportunity where you're seeing greater demand than there is supply that's attractive for you guys?
I mean, I think one of the things that we're seeing is an interesting convergence and dialogue between specific to real estate and to infrastructure. We're actually finding that the banks globally had gotten very long both real estate and infrastructure assets, and are probably a little less aggressive in those sectors, which is great timing for us because particularly on the real estate lending side, on the infrastructure side, And I'd say as well on the digital infrastructure side, that pullback actually allows us a really nice opportunity to kind of press into those areas, which we do view again as really exciting, long-term, sustainable businesses where we think we can share. And again, a lot of the private markets business is about coming in and filling gaps where the banks are creating gaps for companies, and it's very often with middle market companies and middle market assets. So we're following along a lot of the same cues that we have perhaps in some of the other businesses, credit in particular.
Yeah. As you mentioned, Ares has been active in the local market. You're involved in taking a listed company, Invacare, private, participated in refinancing Zip, which has been a comeback story. And also, talking about comeback stories, you helped out with Rugby Australia, which needed some assistance back in 2020. But on the Rugby Australia point, I understand you've found an opportunity and developed a capability in sports and media, and I know you're a passionate sports fan and participant. Maybe you could tell the audience a little bit about the business of investing in sport.
Yeah, well, it's funny. The Rugby Australia transaction is actually a pretty interesting one if you want to go back and rerun it to kind of how we frankly came up with the thinking. So we really had started to think about the overall sports media and entertainment market, which by the way is very, very large, right? We think, $1 trillion plus and largely uncorrelated, driven by pretty strong fundamentals, right? In terms of lack of unscripted comment, live matches, all that stuff, growing media rights. This is a very scarce product these days in terms of entertainment. It's also a industry that had lacked creative financing. So particularly some of the U.S. teams and some of the U.S. assets that we knew well, where we were fans, the financing was bank debt and owners. And there's nothing in between. And I think Ares has done a really nice job over the years of flexing what we do well, which is innovating and bringing creative capital into places where there isn't very innovative capital solutions, and there isn't very creative financing. So we'd started to kind of scope it out a bit, and then all of a sudden COVID hit. And we were like, whoa. And we realized there were going to be no sports for like a year and a half or whatever it was, depending on where you lived. And, maybe it's the way our brains work, but that sort of said opportunity, because there are going to be a lot of people, owners of teams, media companies, owners of stadiums, concessions. You can just go down the line, obviously, of folks whose businesses were going to be fundamentally changed by that pandemic. And that's kind of how we started. That was the thesis. So the Rugby Australia thing obviously plays into that well. Certainly not everything that we've done, because it's gotten to be a very active and large investing franchise for us, is relying anymore on COVID. But we found that when we stood a team up in the space that was global and became experts in all of these different assets, all sorts of opportunities emerged. So we've made some team investments. We've also done a lot away from teams, right? I mentioned stadiums, right? We've done things in concessions. We've done, media rights deals. We've done things with leagues as we did over there. So just once we really stood up a dedicated effort that became experts here, it became obvious to us that not only from where I started, that this market, broadly speaking, was a very attractive and generally uncorrelated to other assets type of space, but one that needed the type of capital that we brought to bear. And we've tried to be very flexible in our approach. So we've said, we'll kind of look at anything, and sometimes we'll be a senior lender, and sometimes we'll be mezz, and sometimes we'll be preferred with upside, and we'll make equity investments as well. And that flexibility of capital is what we've always laid out as part of our corporate and our asset-based investing business. And we said, I think we bring this specifically to the sports media and entertainment market, it'll have traction. But truth be told, to your anecdote about Rugby Australia, the whole thing actually really came to bear during COVID, when I was sitting in this room and my partners and I and others were all on Zoom calls trying to figure out what to do.
And across the spectrum of teams that you invest in the sports, could you give us a couple of names? I understand McLaren's one of the businesses you've supported, and you talked about the uncorrelated returns. What are the returns from investing across sports and media look like?
Yeah, I mean, it sort of depends, again, where you are in the capital structure, right? I would say most of our investing is down the balance sheet, right? So it's subordinated debt through equity. But in terms of teams, we have a minority interest in the Miami Dolphins, which is U.S. football. We have a pretty significant interest in the U.S. football team Inter Miami, obviously in Florida. A pretty significant interest in Atletico Madrid. And then we have what I characterize as, just for teams, probably some things that are more structured, where we're really not even materially or at all part of the ownership group. So Chelsea, the football club, and recently France Sail GP, which is an interesting one. So, there's always a lot of press about big, European football or American football or whatever, but you find there are a lot of actually really interesting niche team investments. France Sail GP is a recent one that we did that was pretty fascinating. So they're broad, but that's just a handful of them for you.
Yeah, very good. Well, Kipp, we're going to wrap things up there. I just wanted to say a big thanks from all of us here at Livewire for waiting up for us this evening, taking the time to jump on the Zoom call. It's been a pleasure to have you involved in Livewire Live this year, and thank you very much for your time. Audience, everyone, could I ask you to put your hands together for Kipp, please?
Thanks so much for having me, guys.